Lunchtime Live, we're back, live and direct from Dubai. Who's up for conquering an AA risk challenge then? Let's have a look at this. So, hopefully you're all well and good and ready for 10 minutes of a little bit of work, maybe a little bit longer. We'll see how we go. Okay, so first thing is, if we can talk about AA risk, we need to know, well, what is audit risk? Now, this is really important to understand. It's the risk that you may give an incorrect audit opinion, but then you've got to ask yourself, well, why might I give an incorrect audit opinion? And the answer to that is because you might have missed a material misstatement in the accounts. So the accounts are wrong materially, and you said they're okay. So let's break that down a bit further. Talking about audit risk, talking about the risk of material misstatement existing and you've missed it. And then there's another element, the risk of you not detecting it. So there might be a material misstatement. There's a risk of that always, isn't there? We'll look into that in a bit more detail. But then you've got the risk of you not picking it up. You're doing audit tests in order to pick it up, aren't you? Now, the risk of the material misstatement existing is because either the area or the industry is inherently risky, cash businesses, startup businesses, whatever it might be, or it could be that the controls didn't catch them, the internal controls didn't catch these errors in the accounts. So I want to have a look at that again. Audit risk is made up of, we're using proper terms now, if you like, the risk of material misstatement. And that's made up of inherent risk and control risk. Inherent risk being the thing that the item is just inherently risky, or control risk, the risk that the controls didn't work. Hey, thumbs up. And then you've got detection risk. Now, which of those is controlled by the client? Is it the risk of material misstatement, or is it detection risk? Which is under the control of the client? And hopefully you can see it's the risk of material misstatement, the inherent risk, the control risk, that's all to do with them. Detection risk, this is the only one that we actually have any control over. So what we mean is, what we're going to do is we're going to do some planning, aren't we? And in the planning, we might work out that the risk of material misstatement on receivables or whatever is quite high. And so therefore, we need to make the detection risk quite low. Because the risk of material misstatement is high, we need to make the risk that we don't pick it up as being low. So therefore, we test more when there's a high risk. Conversely, of course, if during our planning we've decided that the area isn't inherently risky, the controls are great, so there's not much risk about the controls not picking things up, so there's a very low risk, so I can afford to have a high detection risk, a high risk that I won't pick up a material misstatement because I think, well, it's the low risk of them happening anyway. So I would test less. So they always go, you know, one goes up, the other one goes down. Okay, so that's the idea. All still with me? All happy on this sunny Friday? It's sunny here anyway. So here's a scenario for you. It's a new audit client. A new audit client is a risk. What risk is it? Is it inherent? Is it control? Or is it detection risk? A new audit client. And the fact that it's a new audit client, well, that's my worry. So it's the detection risk because I don't know them very well, so I might not be able to detect all the errors. So the potential misstatements would be, as they're new, I never saw last year's closing balances, so the opening balances may be wrong as far as I'm concerned. And because I'm not familiar with the client, it increases the risk of missing errors that they may have made. All kind of makes sense? Let's do another one. So the scenario this time is the managers are getting big bonuses. Is that an inherent risk, a control risk, or a detection risk? Which one is that? And that risk type is an inherent risk. It's just an inherently risky area because if managers get bonuses based on profits, guess what they're going to do? They're going to make profits look really good if they can. If it's based on profits, they might make expenses lower by doing different little things with accounting treatments. So the potential material misstatements would be they would try and overstate revenue or assets, and they would try and understate expenses and liabilities, wouldn't they? Hopefully that all makes sense. Let's go again. Excuse me. So, scenario number 3. There's a new accounting standard out. Is that control, inherent, or detection risk? Quickly. Inherent risk, just an inherently risky thing. It's new accounting standard. Nobody knows what hasn't done it loads and loads of times. So there's potential error going to be going on just inherently. You're going to incorrectly apply the standard because you haven't done it lots and lots of times. And that might lead to misstatements, basically. Okay, what's next? New scenario would be, all these scenarios come up in the exams, by the way. So a complex transaction like, I don't know, there's been an acquisition or some financial instrument derivative. What sort of risk is that for us? Would you say that's a control risk, a detection risk, or an inherent risk? And again, it's just inherently risky, isn't it? That it's complex, so we might make an error. You know, it's quite straightforward, really, incorrect accounting treatment. Remember, all of these come up in your exam all the time, all these sorts of scenarios. Staff shortages, high staff turnover, inexperienced staff. What sort of risk is that? Is it control, inherent, or detection? So having inexperienced staff due to high staff turnover, that's a control risk. It's a risk that the staff might not be following the controls, the systems that we've set up. And so, therefore, we're going to have potential material misstatements here. So the likelihood of them making errors, basically. All right, still with me? Keep going. Next scenario. New IT system. So new IT system, working on it for the first ever time, inherent, control, or detection. It's inherently risky, but it's a control risk, really, because the potential misstatements are you might lose your data, or data get corrupted as you go from one to the other. System errors, so problems with the whole system. That's why we're looking at control. And control weaknesses in the new system because we haven't had time to properly set them up. Okay. Keep going. Next scenario. Significant related party transactions, so huge related party transactions going on. Risk type inherent, that's just an inherently risky thing. We're not saying that there are going to be errors, we're just saying there potentially could be errors here because the transactions probably won't be at arm's length because they're related parties. We may not have disclosed them all because sometimes they're at zero values, so they might not get in there. And also there's a potential for fraud as well, isn't there? Okay, so hopefully you're getting a grip of this now. So what about this one? Lack of segregation, no authorization. What sort of risk is that? So it's lack of segregation of duties, people not being authorized properly to do things. That's our systems going wrong, isn't it? That's our control risk. We're not saying there are going to be errors, but we're saying potentially this is an area where we need to look at because there may be errors going undetected. So what I'm showing you here is there's all these risk types. I'm working out, is there a risk of material misstatement? The higher the risk, the lower the detection risk I'm prepared to accept, so I'll test more. The lower the risk, the higher the detection risk I'm prepared to accept, so I'll test less. So all of this is making me think about, in the exam, identifying a potential risk, explaining why it's a potential risk, and therefore I will test that area more if it's a high risk. So now we're coming to exam technique, if you like. First of all, you identify the issue. That's what we've been doing just now. And you identify the issue by briefly stating the relevant fact or issue from the scenario, i.e. there were management bonuses. You can copy and paste from the scenario, but only small bits, please, because you won't be adding any value. But you'll get half a mark for identifying. But this is the key bit where you explain, you say, well, why is this an issue? You know, is it because the IFRS is complex? Is it because the IFRS is new? Is it because the transaction is complex? Is it because there's potentially a lack of controls here, a new IT system, whatever? And then you go on to say, and so therefore this increases inherent risk or control risk. Doesn't matter if you don't get them entirely right, but try and get them correct. So you explain why it's an issue. You say therefore it increases inherent or control risk. And then you go on and say, right, now there's an impact. And that impact will be the receivables, for example, are overstated, potentially, or profits are overstated, potentially, or expenses are understated, potentially. Try and always say which balance is affected and how, under or over, or if it could be either, just put misstated. Okay, but don't just always put misstated thinking, I'm clever here, I don't have to say under or over. You know, they will be expecting under certain circumstances to get that right. Okay, and you can also link the risk to the most relevant assertions. If you saw our lunchtime live on substantive issues a while back, if not, it's on our YouTube channel, just go under the live button and you'll find the video there. We talked about assertions, didn't we? Valuation, cut off, all those sorts of things, existence, ownership, you know. So say which assertion as well. So we're nearly there. Here's an identification point. So an example, Cow has included $500,000 for a 5-year servicing plan within the cost of a new asset. And you say, well, that's a risk. That's a risk of material misstatement. Well, it is a material misstatement because servicing and maintenance costs are revenue expenditure, i.e. they should go in the P&L, not on the SFP. So we know that that's an issue. Or it could be, this is possibly going to be an issue, depending on what the identification was. And you say, look, and capitalising these costs inappropriately inflates the assets carrying amount, inflates PPE. So you explained why it's an issue, you've explained what the IFRS should be, then you go on and talk about the impact. So you say, look, the PPE could be overstated because you've included costs that should have been an expense. So therefore, expenses are understated. And you could also mention the assertions of valuation and accuracy as well. So that's just to get like the perfect answer. Identify, explain, impact, say the account balance, say whether it's understated or overstated, maybe mention an assertion. Do all those and you've definitely got, 2 marks, I would say. So I thought what I'd show you at the end here is what I call a poor answer. The company has a bonus scheme, so we know that's a risk, don't we? We know that's so you get a half a mark for identification. So there is a risk of misstatement. You get 0 marks for explanation and impact, wouldn't you? And you now know that after just your 13 minutes with me, you now know that's a terrible answer and you know how to improve it because you're going to identify it, you're going to explain it, and you're going to say what the impact is. So the good answer would say the director's bonus scheme is linked to reported profits. That's the identification, half a mark. The poor answer would have got half a mark as well. This creates a self-interest threat and increases inherent risk due to potential management bias. They may try to show profits to be higher than they really are. It's just inherently risky. We're not saying they are doing it, by the way. We just say, look, this is an inherently risky thing. This is why I want to go and test more here to make sure that they haven't done it. I'm not saying they have. I'm just saying it's a risk. So you've explained why. So now we go on to the impact, don't we? So you say, look, there's a risk that management may manipulate earnings by, for example, overstating revenue, which would affect the occurrence assertion. You don't have to say the assertions if you've done the overstating or understating. And then say, or there could be understating expenses like provisions affecting the completeness and valuation assertions, which is the impact. Now, as I say, I don't really expect you to get the assertions, but if you do know the assertions, fantastic. If not, explain the issue, say which balance, say whether you're worried about it being understated or overstated, and you're going to get 2 marks for every risk So you're going to pass easily just with a few risks. So hopefully that has been of great use to you. It just leaves me to say thank you very much. Hope you're enjoying the lunchtime lives. I enjoy doing them, so do get in touch with me if you want to see something specifically. I've had a few queries now or requests of what we want to do in the future, so we'll definitely be doing those. Yeah, and like and subscribe at YouTube, and I'll see you on Monday. Have a lovely weekend, everybody.